Good morning. Thank you for joining today's daily webinar where we discuss certain topics. Today's topic is, should I make after-tax 401k contributions? We'll also go over any live questions you have. So go ahead and type those over, shoot them over, and we'll pause and answer your questions, whether it's surrounding solo 401k plans or IRAs. Also, please make sure to subscribe so that you get notifications of when we go live so that you can ask your questions live on the air as well. So, are you self-employed or running a side hustle and wondering if after-tax contributions to your solo 401k are worth it? Or are you also a full-time employer and you participate in a 401k through your daytime employer? And that daytime employer allows for after-tax contributions? Is that also worth it, making contributions to your daytime employer 401k? So most people already know that you can make pre-tax and Roth contributions, but what about voluntary after-tax contributions? These contributions are oftentimes overlooked, yet they can open the door to powerful tax strategies, especially if you are trying to max out your savings beyond the standard contribution limits. So in this webinar, we'll break it all down for you. Here's a preview of what you'll learn. So one, what exactly are after-tax 401k contributions, including after-tax solo 401k contributions? How they are different from Roth and pre-tax contributions. Why high-income earners are using them for the mega backdoor Roth strategy, whether it's the mega backdoor strategy using a solo 401k or the mega backdoor strategy using your daytime employer 401k plan. Also, how to make these contributions and what compliance steps you need to follow. And then we're also going to discuss when it does not make sense to make voluntary after-tax contributions. Plus, we'll go over mistakes to avoid, like making after-tax contributions without a plan to convert them, or choosing a solo 401k provider that does not support any planned Roth rollovers. And also making sure that if you're contributing to a daytime employer 401k, that the daytime employer 401k allows for voluntary after-tax contributions. So, should you make after-tax solo 401k contributions or voluntary after-tax 401k contributions to your daytime employer? If you are aiming to grow your retirement nest egg and stay tax efficient, this one session you don't want to miss. Again, so please go ahead and make sure to subscribe so that you get notifications when we go live, so that you can ask your questions live on the air as well. So we'll help you make an informed decision and possibly uncover one of the most powerful solo 401k, aka individual 401k, and even traditional 401k strategies out there. All right, looks like we've got a question live on the air here. Let's pause and take a look at that question. So it says, I have an IRA LLC created. The IRA LLC is owned by two different IRAs. One is mine and one of spouses. Let's call this IRA LLC 1. Okay, yep, you are allowed to pool your respective IRAs in the same LLC. whether it's your IRA or your spouse's IRA, there are certain rules that apply, such as making sure that that LLC is created for the first time and that that LLC is funded at the same time by both IRAs. And you also want to make sure that the LLC operating agreement lists the percentage of ownership by each IRA. All right, looks like you got a follow-up question there. Can this IRA LLC one create a joint venture LLC with another LLC? And another LLC can invest in real estate? Well, that's a loaded question. Typically, when you fund an LLC with your IRA or your spouse's IRA, that particular LLC is used for investing in real estate. If now you're trying to get creative and you want to invest that LLC in another LLC, then there's a whole other set of regulations that come into play, such as that second LLC not being your LLC, and also that second LLC making sure that that LLC one does not own a 50% or more interest in that LLC. You also have to consider other items, such as who are the other members of that LLC too, because if you have certain family members that are also a member in that LLC, then that might make it prohibited. So that type of question is one that's very tough to answer just on a live webinar. That type of question I like to, or that type of strategy, I like to call it pushing the envelope. So if you have more questions surrounding that particular topic, go ahead and send over an email to business@mysolo401k.net and we'll gladly take a look at it. All right. Looks like we have another question here. Let's see here. I just started a LLC in my Roth IRA. Excuse me. We bought a house that we are rehabbing. Then we will rent it out long term. We hold the cash in an account at Schwab. So we can do options trading with the spare capital. What kind of potential risk and hazards should we watch out for to stay fully compliant? I'm terrified that we will make a misstep and cause my account to be distributed. Well, here's another example of a loaded question as well. So let's take a look at it. So I presume when you say you just started an LLC in my Roth IRA, you're saying that you invested your Roth IRA in an LLC, resulting in what's referred to as a single member LLC, whereby the Roth IRA is the single member of that LLC, oftentimes referred to as a Roth IRA LLC or a Roth IRA LLC with checkbook control. So if that's the case, then yes, that type of Roth IRA LLC may invest in real estate. With regards to rehabbing the property, the costs to rehab that property has to be paid for with Roth IRA LLC funds. Second, you have to hire contractors to do the rehab work. Neither you nor disqualified parties like your spouse or children or parents, for instance, can do the work on that property. That would result in a prohibited transaction. What is more, when that property is rented out, all that rental income needs to flow back to the bank account for that Roth IRA LLC. Now, with respect to investing in options, if you open up a brokerage account for that Roth IRA LLC, it is worth noting that most brokerage firms do not provide brokerage accounts for IRA LLCs, whether a Roth IRA LLC or an IRA LLC. But if you do find a brokerage firm that does, you need to make sure that brokerage account is titled in the name of the Roth IRA LLC, and that brokerage account is funded with funds from that Roth IRA LLC bank account. And when you start doing trading, whether it's equity trading, options trading, that's going to be done in that Roth IRA LLC brokerage account. And as long as it's done inside our Roth IRA LLC brokerage account, there won't be any issues because all the funds will stay within that Roth IRA LLC brokerage account. So hopefully that answers that question. All right. So if you have any other questions, go ahead and shoot them over. We'll take a look at them. All right. So let's go ahead and continue asking your questions, and let me get back here to our topic for today, which is, should I make after-tax 401k contributions? So first, let's define what an after-tax 401k contribution is. So don't confuse after-tax 401k contributions with Roth 401k contributions, because Roth 401k contributions are also made on an after-tax basis, which means that you don't get a deduction on your tax return in the year that you make that Roth 401k contribution, whether it's a Roth 401k contribution or a Roth solo 401k contribution. Same thing with a voluntary after-tax 401k contribution. You don't get a deduction on your tax return either for making that voluntary after-tax 401k contribution in the year that you make it. Same thing with voluntary after-tax solo 401k contributions. So even though a voluntary after-tax solo 401k contribution, just like a Roth IRA, is made with post-tax funds, meaning you don't get a deduction on your tax return for making that contribution, they are still different. So a voluntary after-tax 401k contribution is a way to get more Roth 401k funds in your 401k above the typical Roth 401k contribution limit. For instance, the Roth 401k contribution limit for tax year 2025 is $23,500 when we're talking about employee 401k contributions. So let's say that you want to be able to get more Roth 401k funds into the plan. You're going to be able to do that by utilizing the voluntary after-tax solo 401k contribution, or in the case of a full-time employer 401k, the voluntary after-tax 401k contribution. So the overall contribution limit to a 401k plan, whether a traditional 401k plan, aka a full-time employer 401k, or a self-employed solo 401k, the overall contribution limit is $70,000 for tax year 2025. So, in the context of a traditional 401k, let's say that you maximize your Roth 401k contribution of $23,500. And now you want to get more Roth 401k into that traditional full-time employer 401k. Well, first you want to make sure that that traditional 401k employer plan allows for voluntary after-tax contributions. For example, I know that the Amazon 401k does allow for voluntary after-tax 401k contributions. So if you work for Amazon, and let's say you've already contributed the 23,500 Roth 401k contribution to that Amazon 401k plan, and now you want to get more Roth 401k money into that plan, well, you're going to be able to contribute the difference of $70,000 and $23,500 as a voluntary after-tax 401k contribution, provided that you have enough earned income from your Amazon business. So in your case, W-2 wages from your employer, that being Amazon. So you work for Amazon. So if you get at least $70,000 of W-2 wages from your Amazon employer 401k, you're going to be able to contribute $23,500 of that as a Roth 401k contribution. And then the difference of that as a voluntary after-tax 401k contribution to that Amazon 401k plan. Now let's talk about a solo 401k plan. It's similar. Let's say you're self-employed in your own S corporation and you open a solo 401k plan. Well, you can choose to solely make voluntary after-tax solo 401k contributions and forego making Roth solo 401k contributions, as well as forego making pre-tax employer or pre-tax employee contributions. So if you make at least 70,000 of W-2 wages from your S corporation self-employed business that sponsors your solo 401k plan, you can contribute that entire $70,000 as a voluntary after-tax solo 401k contribution and then convert it to the Roth solo 401k or the Roth IRA. Or you could chop it up. In other words, you can say, I'm going to contribute $23,500 as a pre-tax employee contribution to my solo 401k plan. And then the difference up to 70,000, I'm going to apply it as a voluntary after-tax solo 401k contribution. So the difference would be made to the solo 401k voluntary after-tax holding account, aka a bank or brokerage account in the name of the solo 401k, and then it would get converted to the Roth solo 401k or the Roth IRA. So in short, voluntary after-tax 401k contributions can be made to a solo 401k, or it can be made to your daytime employer 401k, provided your daytime employer, such as Amazon, allows for voluntary after-tax contributions. So thus far, we've talked about what exactly a voluntary after-tax contribution is, whether it's a voluntary after-tax solo 401k contribution or a voluntary after-tax 401k contributions. We've also talked about the difference between a Roth 401k contribution and a voluntary after-tax 401k contribution. Again, please go ahead and make sure to subscribe to our channel here so that you get notifications of when we go live, so that you can ask your questions live on the air. That being said, it looks like we've got some more questions here. Let's pause for a moment and take a look at those questions. Okay, let's see here. It looks like we got a question here. It says, we have a solo 401k. We want to take some of the cash and buy gold coins, which will be physically held at Equity Trust. They are giving us a pushback about doing the rollover because they are trying to convert the money into a traditional IRA. How do we word it to make sure it's staying in the 401k bucket? Well, number one, you're not going to be able to store coins or physical metals at Equity Trust because you don't have a solo 401k at Equity Trust. If you have your solo 401k with our company, then I can see why Equity Trust is getting confused. So the solo 401k provided by my solo 401k financial allows for investing in alternative investments as well as precious metals, as long as those metals are allowed, such as American Eagle coins, for instance, or silver coins. And what is more, when you invest in those types of precious metals, you can store those precious metals in a safety deposit box at your local bank in the name of the solo 401k. And only that safety deposit box is used to store metals owned by the plan. And you can also store other assets of the plan, such as deeds of trust if you invest in real estate. Now, if you're trying to use, I'm not even sure why you would even use equity trust in this equation, but it kind of defeats the whole purpose of having a self-directed solo 401k. If you're looking to use equity trusts for a self-directed IRA, and provided that you meet a triggering event, such as being able to transfer self-directed solo 401k funds to a self-directed IRA because you're age 59 and a half or older, or you're transferring funds that were previously transferred to that solo 401k from an IRA or a former employer plan, then you can do a partial transfer to a self-directed IRA and equity trust and then make that investment. But it sounds like you're going around a circle because the whole purpose of opening up a self-directed solo 401k with a plan document provider such as my solo 401k financial is so that you can choose where to store those metals at. And usually clients like to store them at their local bank instead of somewhere at a trust company or a depository company like Delaware Depository, where they may mix all your metals with other people's metals, and you have no idea whose metals they are. And when it's time to get those metals out, you may not be able to get a hold of them. By having them in a safety deposit box in the name of the plan of your local bank, you can ensure that just your metals are in that box. Okay, if you still have questions about your particular situation, go ahead and submit a support ticket because even though these daily webinars are great for answering questions, it's oftentimes tough to understand your full situation. So go ahead and submit a support ticket and we can review your situation in more detail. Let me go ahead and send over a link to our support ticket. Right here is where you can submit a support ticket. Okay, so let's go back here and take a look at some other. Let's go back here. It looks like we don't have any other questions for now. Let's continue with our daily webinar topic for today, but don't hesitate to shoot over any other questions as they come up. And we'll pause and we'll go ahead and answer those live on the air. So we've been talking about, should I make after-tax 1K contributions, whether it's voluntary after-tax contributions to your daytime employer 401k, such as your Amazon 401k if you work for Amazon, for instance, because we do know that the Amazon 401k does allow for voluntary after-tax 401k contributions, or whether you're making voluntary after-tax contributions to your solo 401k. So let's pick up where we left off. So why are high income earners using the mega backdoor Roth strategy? Well, quite simple. High income earners, and you don't have to be a high income earner, of course, to utilize the mega backdoor Roth strategy, whether it's the mega backdoor Roth solo 401k strategy or the mega backdoor Roth 401k strategy. But we find that a lot of high income earners like to use it in the following scenario. Let's say that you are a employee, a W-2 employee of Amazon, and you also participate in Amazon's 401k. Let's further assume that you also are self-employed on the side. You also have your own consulting business on the side. So you are moonlighting. Let's also assume that you decide that you also want to open up a solo 401k plan for that self-employed business. Let's further assume that you want to maximize your voluntary after-tax solo 401k contributions and that you also maximize your contributions to your daytime employer 401k Amazon plan. So yes, you heard that right. You can fully maximize your daytime employer 401k plan. And then you can also turn around and also maximize your solo 401k contributions as well. So let's provide an example here. let's say that Dan is a full-time employer, that Dan is employed full-time with Amazon, and that Dan maximizes his annual contributions to the Amazon 401k. So that means Dan makes a total of $70,000 in contributions to that Amazon employer 401k. Let's further assume that Dan is self-employed on the side in his own consulting business as well. So and let's say that his consulting business is taxed as an S corporation. So Dan opens up a self-employed solo 401k plan for his consulting business, his S corporation consulting business. Let's further assume that Dan is able to generate $70,000 in W-2 wages from his S corporation self-employed business. Well, Dan can turn around and contribute that entire $70,000 to the voluntary after-tax solo 401k, and then convert that to the Roth solo 401k or the Roth IRA, resulting in Dan having contributed $70,000 to his daytime employer Amazon 401k, and another $70,000 to a solo 401k plan, for a total of $140,000 in 401k contributions. So that's how a lot of high income earners are utilizing the Mega Backdoor Roth 401k and the Mega Backdoor Roth Solo 401k strategy. They are using both strategies because they work for both a daytime employer 401k that allows for the Mega Backdoor Roth 401k strategy. And then they also are self-employed and open up a self-directed solo 401k plan that allows for the Mega Backdoor Roth solo 401k strategy. So those are items to consider. Now, when does it make sense to make voluntary after-tax solo 401k contributions? Well, one instance is if you're trying to maximize your Roth 401k funds indirectly, because the Mega Backdoor Roth 401k strategy is a way to maximize your Roth 401k contribution indirectly, because that'll get you all the way up to the overall limit by utilizing the Mega Backdoor Roth Solo 401k or Mega Backdoor Roth 401k strategy. That'll get you all the way up to that $70,000 in Roth 401k funds, or Roth Solo 401k funds, or both, in the case of the example I just used for Dan, who happens to work for both Amazon and participates in Amazon's 401k that allows for voluntary after-tax contributions. And he also participates in a solo 401k plan that allows for voluntary after-tax solo 401k contributions. And he has enough W-2 wages from that self-employed S corporation business to maximize his Mega Backdoor Roth solo 401k strategy. So those are things to understand when you ask yourself, should I make after-tax 401k contributions or after-tax solo 401k contributions, or both for that matter? So again, please go ahead and subscribe to our channel here so that you get notifications of future webinars, so that you can jump on and ask your live questions live on the air as well. All right, I don't see any other questions right now, but here are some other items to consider when making a decision about making voluntary after-tax 401k contributions. One, make sure that that traditional 401k or that solo 401k plan allows for voluntary after-tax contributions, as not all plans allow for it. Second, make sure that that plan allows for in-plan Roth rollovers. You have to have both features within that plan, because you don't want to get into a situation where the plan allows for voluntary after-tax contribution, but it does not allow for conversions. That is, being able to convert those voluntary after-tax 401k or voluntary after-tax solo 401k contributions to the Roth 401k or Roth solo 401k or to a Roth IRA. So that's very important to understand. Okay, so again, go ahead and shoot over any questions you might have. Now let's talk about the steps involved in making voluntary after-tax solo 401k contributions so that they can then be converted to the Roth solo 401k or the Roth IRA. Well, first you have to make sure you open up a solo 401k plan with a solo 401k plan document provider, such as my solo 401k financial, whose plan allows for voluntary after-tax solo 401k contributions as well as in-plan conversions, and therefore the mega backdoor Roth solo 401k strategy. Then you want to go ahead and open up that solo 401k plan with that solo 401k provider. Then you're going to need to have separate holding accounts to hold those voluntary after-tax solo 401k funds because they have to be held in a separate holding account. It's still one plan, but it's a separate holding account solely used to hold those voluntary after-tax solo 401k contributions. And our clients here at my solo 401k financial, we give you the option of using a brokerage firm or your local bank to hold those funds. Then you can make that contribution to that voluntary after-tax solo 401k bucket, aka bank or brokerage account known as a holding account, and you make that contribution based on your net self-employment income. So you want to make sure you have enough earned income from your self-employment activity to make that contribution amount, because you can't contribute more than you make. So you got to make sure you have enough funds to make that contribution, and that contribution has to come from your self-employment income. So it's got to be based on your net self-employment income. Once you make that contribution to that dedicated bank or brokerage account in the name of the solo 401k label voluntary after tax, then you also want to make sure you open up a separate bank or brokerage account in the name of the solo 401k to hold those Roth solo 401k funds, because those voluntary after tax contributions then get converted to the Roth solo 401k plan. And it's important to follow these steps. You can't just say, well, I'm going to make my voluntary after-tax solo 401k contribution directly to the Roth solo 401k plan. That's not allowed. That's going to result in a disallowed transaction, and the IRS is going to challenge it and say that it's not a true mega backdoor Roth strategy. So these steps are very crucial. Once you've converted those voluntary after-tax solo 401k funds to that Roth solo 401k holding account, then it needs to get reported to Uncle Sam. That is the Department of the Treasury. That gets reported to the Department of the Treasury on a Form 1099-R. So if you are a client of my solo 401k financial, we have an online conversion form that you would complete, that we would used to collect the information to issue that Form 1099-R. And that form is found right here on the Forms tab of our website. If you click on Forms on the top right-hand corner, you're going to see that online conversion form. So that's the form that you fill out so that we collect the necessary information once you've moved those funds from the voluntary after-tax solo 401k to the Roth solo 401k, or to a Roth IRA for that matter, so that we can report that on a Form 1099-R. And as long as you timely request that 1099-R by the end of the year, we'll go ahead and issue that Form 1099-R by January, February of the following year. So for instance, any mega backdoor Roth solo 401k conversions processed here in 2025, those get reported to the IRS on a Form 1099-R, which gets issued to the IRS January, February of 2026. And a copy also goes to you. And if you're a client of my solo 401k financial, as long as you timely request that Form 1099-R, we won't charge additional fees to do that reporting. We'll cover that in our annual fee. Now, we often get the question, should I convert to a Roth IRA or to the Roth Solo 401k? Well, most clients will convert their voluntary after-tax Solo 401k contributions to a Roth Solo 401k instead of a Roth IRA. Reason being is that a Roth Solo 401k is now subject to require minimum distributions, just like a Roth IRA, and you have the Secure Act to thank for that. It used to be that Roth Solo 401k plans were subject to require minimum distributions. Well, that no longer applies. What is more, clients prefer to convert to the Roth Solo 401k plan because they want to keep the funds within the plan. And they also can take a participant loan. They can borrow from the Roth Solo 401k plan, whereas the Roth IRA regulations do not allow for participant loans. Also, if you are investing in real estate and you're utilizing debt financing to invest in real estate, people prefer to do that through their self-directed Roth Solo 401k plan because they can utilize a non-recourse loan known as debt financing without triggering unrelated debt finance income tax. If you do that same strategy through a Roth IRA, then it's going to trigger that unrelated debt finance income tax, which does not apply to Roth Solo 401ks. So those are items to consider. Okay, I don't see any other questions here today. We do appreciate you joining today's daily webinar. Please go ahead and like our channel, subscribe to our channel so that you get notifications of when we go live. Until next time, have a good rest of the day.